It's 4018 on a Thursday, and Devin is unlocking his HVAC shop because payroll goes out before breakfast and a supplier payment is already late. The email looks ordinary, same vendor name, same tone. New bank details. One click, one ACH batch, and $18,000 walks out. Nobody hacked Devin's accounting software. Nobody broke a firewall. The scam only needed one busy person to believe one believable change request. That is the payment fraud fire drill most small businesses need before June 22nd. Not panic. A routine. A second set of eyes. AFP's 2026 survey found 76% of organizations faced attempted or actual payments fraud in 2025. That is not an enterprise-only headache. Small firms feel it harder because one person often wears 3 hats: bookkeeper, approver, and emergency problem solver when the bank calls. The same AFP report says checks remain the payment method most frequently hit by fraud, with 58% of organizations reporting check fraud in 2025. So consider this week's question simple. Before money leaves, who verifies the destination, and who approves that the payment should move? Devin's shop paid vendors every Friday. The bookkeeper prepared the file. Devin approved it between service calls, usually from the truck. Federal Reserve Financial Services cited AFP's 2025 survey showing 63% reported check fraud in 2024, while 91% still use checks. Checks are familiar. ACH is efficient. Wires feel official. But every money-out channel can become a shortcut for someone pretending to belong. The Federal Reserve has said checks repeatedly top the list of payment methods most susceptible to fraud, especially with mail theft and altered instruments. One practical move may help. Stop treating payment method choice as convenience only. Treat it as a control decision. Devin remembered the moment later. He was in a parking lot, phone buzzing, thumb on approve, thinking about the next broken compressor. That is exactly when false urgency wins. Fraudsters do not need your slow day. They need your rushed day. Nacha Phase 1 fraud monitoring rules took effect March 20, 2026 for banks and larger ACH originators above specified volume thresholds. If you are smaller, do not tune out. The second phase is where Main Street starts getting pulled into the same control conversation. Start by mapping every way money leaves: payroll, vendor ACH, rent, refunds, owner draws, bill pay, checks, wires, and card chargebacks. Do not make this fancy. A plain sheet, a shared document, or one accounting note may be enough to reveal the weak spots. Then mark 3 events in red mentally: a new vendor, a changed bank account, and a payment above your chosen threshold. For Devin, the threshold became $5,000. Not magic, just high enough to catch painful mistakes without freezing normal bills. Nacha Phase 2 applies to other non-consumer ACH originators with a practical compliance date of June 22nd because June 19th is a federal holiday. Firmly, a 2-person rule is not bureaucracy. For a small company, it is a seatbelt you put on before the road gets slick. One person can enter the payment, a different person approves it. For owner-only shops, your accountant can be that second checkpoint. Devin's bookkeeper still billed the Friday ACH batch. Devin still approved it. But bank changes now took a detour. Nacha's new rules define fraud under false pretenses, including business email compromise, vendor impersonation, payroll impersonation, and other payee impersonation scenarios. That matters because the fraud often looks like normal business. It sounds polite. It references real invoices. It knows your vendor's name. For any bank account change, consider requiring a callback using a number you already trust, not the number inside the request. Devin called the supplier's old contact from last year's onboarding packet. The real supplier had never changed banks. Nacha says a risk-based approach should not be used to conclude that no monitoring is necessary at all. Small does not mean exempt. Reasonable monitoring can be modest. Many businesses may start with thresholds, approvals, alerts, and a daily glance at bank activity. Ask your bank about ACH debit blocks, ACH filters, positive pay for checks, wire templates, and same-day transaction alerts. If a tool costs money, compare it against one bad payment. A $30 monthly control may look different beside a $10,000 loss. Checks deserve their own conversation. They expose routing and account information, travel through mail, and can be copied, washed, or redirected. Federal Reserve Consumer Compliance Outlook noted about 680,000 suspicious activity reports for possible check fraud in 2022, a sharp jump from 2021. If you still need checks, consider positive pay, tighter storage, fewer signers, and a routine for mailing from secure locations. Store blank checks like cash. Limit who can access them. Review cleared check images if your bank makes them available. For refunds, use the original payment channel when practical. A refund request to a new account should trigger the same callback rule. Softly, here is the emotional part. Fraud feels embarrassing. Founders replay the decision and wonder how they missed it. Nacha's Phase 2 guidance emphasizes fraud monitoring for non-consumer originators, third-party senders, and service providers, not just the biggest players. A good control should protect honest people from rushed moments. It should not treat your team like suspects. Write one sentence into your payment process. No new destination gets paid until 2 people verify it through separate channels. Then define separate channels. Email plus email is not separate. Email plus a known phone number is better. Devin added a vendor master list. Not complicated. Vendor name, trusted contact, approved bank nickname, last verification date, and who checked it. If you use QuickBooks, Xero, Bill, Gusto, or your bank portal, consider turning on approval workflows where available. If the software cannot do it, use a manual rule, preparer initials, approver initials, and save proof of the callback. Save the evidence in one place. A folder for vendor changes may help you prove the process happened if questions come later. The first Friday with a new routine felt slower. 8 extra minutes, Devin grumbled. Then the system caught a fake rent update. Nacha identifies vendor impersonation and payroll impersonation as false pretenses scenarios, which is exactly the lane these fake change requests use. Payroll deserves special caution. A direct deposit change from an employee should be verified through your normal employee contact path. Calling people, getting period for bank changes. For example, approve today, pay the new destination on the next cycle, not immediately. For urgent exceptions, require owner approval and a documented callback. Urgency should raise the bar, not lower it. Fraudsters love the phrase today only. Real vendors may be annoyed by verification, but most understand protecting a payment. You may want to tell vendors ahead of time. Our company verifies bank changes by callback. That sets expectations before pressure arrives. Build a fraud response plan on one page. Who calls the bank? Who freezes payments? Who contacts vendors? Who preserves emails? If money moves to the wrong place, minutes matter. Call the bank first, then your processor, then law enforcement if appropriate. Daily reconciliation sounds boring until it saves you. During payroll and vendor weeks, look at bank activity each morning. You do not need forensic accounting. You need a habit. Did every debit match a payment we expected? Set bank alerts for outgoing ACH, wires, and checks clearing above your threshold. Alerts may help you catch movement while recall is possible. Review user access quarterly. Remove old employees, old accountants, old owners, and anyone who no longer needs payment authority. The hard truth is that trust and verification have to live together, especially when everyone is tired. A control that depends on perfect attention will fail eventually. A control that catches distraction may actually fit real founder life. So, run a 10-minute drill this week. Pick one fake vendor change and walk through what your team would do. Devin's team found 2 gaps during their drill. Nobody knew the bank's after-hours number, and refunds had no approval threshold. That is the point. The drill is not proof you are careless. It is how a careful business gets stronger. By June 22nd, consider having 3 things written down: payment map, 2-person rule, and response plan. This content is for educational and informational purposes only and does not constitute financial advice. Always consult with a qualified financial advisor or business consultant before making significant financial decisions. That is not financial advice. It is operating hygiene. Your bank, accountant, and processor can help tailor the controls to your setup. If this saves you one awkward payment conversation, like or subscribe. It helps other founders find the signal before the fire drill. Devin did not become paranoid. He became slower in the right places. New bank details. Big payments. Urgent requests. That is the whole play. Slow down the moment where fraud wants speed. Add another human before money moves. The scam does not need to hack your business if it can trick one person. So do not leave one person alone. Build the routine now. When June 22nd arrives, you will not be scrambling. You will already know who checks, who approves, and who calls.